AIG was the poster child for the financial crisis. You had a very large, the largest insurance company that we've ever known at that time, and it had a small operation, a financial products group in London, that was writing credit default swaps. And it wasn't regulated by any U.S. insurance regulator or any UK insurance regulator. It was regulated by a federal office of thrift, I believe. And that entity wrote so many credit default swaps that when they went down, they took not only the company down with them, but basically the world's economy came grinding to a halt in the worst recession that we've known in our lifetimes, and obviously the worst since the Great Depression of the late 1920s. So from the Dodd-Frank Act standpoint, as well as what's going on in Europe and around the world and Asia as well, is how do we prevent, as regulators, prevent that from ever happening again? And that's what we're trying to focus on, is what is the best way to do that. And some of the items that are being focused on and used as tools internationally as well as here in the United States are the concept of group supervision, where you're not just looking at, if I have, I'll use Travelers for example, I have a Travelers subsidiary that's my domestic, that I can see all the records and I can see all the financials and I can talk to the company and get confidential information. But what we're trying to do now is understand the enterprise risk, the risk of the entity wherever it's doing business. And group supervision and the use of supervisory colleges, which are forums whereby regulators from all the different jurisdictions throughout the world that govern or manage parts of a big company's and internationally active insurance company's business, get together, share information, talk about what the risks are, understand where there may be concentrations of risk that they need to look at, and debate and decide how best to regulate that company. And you have the company as well. The best supervisory colleges are the ones where the companies are actively involved, and you get a sense of how they understand and assess and manage their own risks, wherever those risks may be sitting, whether it's in Europe, whether it's in some place in Asia, or right here in Hartford. So those are the things that are going on internationally as well, in terms of trying to fix the problems that we've all encountered without over-regulating, without saying capital is the answer to every issue. Because if you require too much capital, then you're asking for companies to either accept a lower return on their capital, which means that if they don't feel they can make money, they'll put their capital to other businesses, not insurance, which means the availability of product goes away, which is important to everybody in this room, or they have to raise their prices to make the kind of return that they need to effectively be in this business, and that means it's going to cost our consumers more money, and neither of those is a particularly good thing. So the idea is to regulate appropriately and holistically, but not to have a knee-jerk reaction and just ask for more capital, which of course is what's going on in Europe. There's a sense that the insurance industry is very similar to banking, and of course it's very different than banking. And we can talk some more about that. But let me shift gears really quickly and talk about some things that are closer to home. And that's our legislature and what's happening in the legislature currently. The session started about a month ago. It's a short session this year. It ends the first week, or I think May 9th, so the beginning of the second week of May. And there's a lot of time between now and then for the legislature to introduce and pass all sorts of bills. So I just want to touch base on some of the ones that I think would be of most interest to the people in this room. The first is House Bill 5230, which is the hurricane deductible bill. Many of you know that when the tropical storm Irene came through, there were some hurricane deductibles triggered in Connecticut. They weren't triggered in Rhode Island, New York, or New Jersey. And the reason was that our bulletin had some language in it that said, if, like all the other states, that if the Weather Service declares a warning for a hurricane warning for the state, that any damage incurred from the time that warning is issued until 24 hours after the warning is done, it's been pulled down, is coverable by the hurricane deductible provision. The problem was ours didn't specifically say there had to be a hurricane in the state. And of course with Irene, there was a warning, but there was no hurricane. And that resulted in the issue of having to request that, and several companies basically volunteered right away and said, you know what, this is not what was intended, we're waiving it. Some companies said, well, we really require it in our documents anyway, that there be a hurricane, so regardless of the bulletin, we didn't have it, so it wasn't triggered. And there were some companies that actually had language that would have allowed them to press the hurricane deductible and did not, chose not to. There was one company that refused to be, and I spoke with the CEO on 4 occasions personally, and they had the right to enforce the deductible on a certain number of policies, and they did. So the legislature has decided they would like to put an act in place that kind of formalizes when a hurricane deductible gets triggered and where. We, in the meantime, upgraded our bulletin back in late November, early December to make it clear that there has to be a hurricane. And after talking with staff, my conclusion was what we really want to do is make a very simple, straightforward. We don't want to fix a big problem if it didn't exist. We had one simple problem. Let's fix that one simple problem and make sure that there has to be a hurricane. So that's what we did. Our goal was clarity and common sense. There has to be a warning by the National Weather Service, and they must also declare that a hurricane, which is sustainable winds for a minute or more, or 2 minutes or more, of 74 miles an hour or greater in the state. So that's what the bulletin says now. Because it wasn't in statute, we were able to fix it. We had the flexibility to fix the bulletin right away. And my suggestion to the legislature has been not to pass this law, because if we have issues in the future, we won't be able to fix it with the bulletin because it's in the legislature. On the other hand, the legislature thinks it's important enough that they pass a law, and so we're going to see where that goes. Excuse me. The next bill is what we refer to as, and that's not our bill, that was being proposed by the legislature, by the committee itself. House Bill 5386 is a general revisions bill. This is our bill. We've submitted some enhanced consumer protections in the bill. We've tried to add efficiency to the regulatory process, changes that we think will help you as well as us at the department. One of the examples is we're proposing that, and I talked with some of your folks at the reception in Hartford last week, we're proposing that brokers no longer have to file an affidavit for every surplus lines procurement. We're going to try to replace that with a quarterly electronic submission to bring it up into the 21st century like everything else. It's less paperwork, it's less time, and it's hopefully more time for you to conduct your business instead of doing paperwork. Another bill is Senate Bill 318. It's the elimination, this is the proposal, this is not our bill, I hasten to add, to eliminate single limits for auto insurance policies. We were opposed to the bill. We know the industry is opposed to the bill. It would affect both commercial and personal lines on passenger vehicles. We think it's bad for consumers, and we think it's bad for the market. It would reduce consumer choice. It would hamper what we think is a very robust and competitive market here in Connecticut, unlike a lot of other states. We have over 100 companies writing auto insurance here, and most of the commercial auto policies are written only on a combined single limits basis. At least that's what I'm told. And so we're going to continue to track the bill. We have stated our opposition to the bill, and if any of you have any views on it, we certainly think it's worth your while to be heard in the Capitol on that issue as well.